Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host. And once again, I'm joined with my good friend, Doug Heagren. Hey, Doug.
Hey, Kirk, how you doing? Hey, listen, if you need us to get more inflammatory, you can always just give me the hint. I can drop in another topic about heroin. We can always throw that back in now and then just to keep everybody on their toes. And by the way, Karen, if you're out there listening, I know a couple weeks ago, please feel free to chime in because I thought that was a really exciting conversation that we had with you. And anybody else that's out there, please feel free to drop in some stuff into the chat. I mean, it always helps us to kind of think about what you want to hear and talk about that. So, but thanks for having me again, Kirk.
Yeah, no, appreciate that, Doug. And just for the listeners who are not aware, we go Friday at 1 o'clock Eastern every Friday. Once in a while, we go on a Monday, but pretty much every Friday at 1 o'clock on LinkedIn, we're live. So if you have questions, come join us. I know a lot of listeners send us tons of questions over our website, over email. Keep them coming, but the live stuff's fun. You know, we can always have a little fun with that, especially on a Friday. So let's just dive right in. So there's so much to talk about this week. I'm a little under the weather. I wish I had a little more pep with me today. But one thing I was putting together some stuff for today, and I was laughing because somebody had mentioned that mortgage rates are back up to 7%, and they were 6.25 like I don't know a week or two ago, and now they're back up to 7. I had no idea they were back up to 7. like where was I sleeping under a bridge? Well, maybe I'll have to if they go any higher. But if you look at 7%, we talked about it before. 7.5% is a double from where it was in 2021, where it was 2.5. That is effectively doubling the mortgage payments, and yet somehow real estate prices last year were up 10%. Go figure. I don't know how or why that happened, but well, I do. But we'll get into that a little bit. But I think what's important to recognize is that just because, well, let me start here. Anytime you're looking at economic data, investment data, anything relating to investing, if you look at something and say, you know what, that doesn't make sense, you should always have your antennas up for, that doesn't make sense. If you ever find yourself saying that, it is a red alert to stop what you're doing, take a step back, and understand why it doesn't make sense. If you can't understand it, pass and do something else. This is one thing I've learned over the years. I've been doing this for 24 years, and I've seen a number of recessions, a number of bad experiences. And anytime I've seen, that's weird, that doesn't make sense. Think of Harry Markopolos, one of the only guys who kind of was basically trying to bring down Madoff because he's like, this doesn't make sense. He's like, none of the data he says he's doing shows up on the tape. No one's processing his trades, so it doesn't exist. And turns out he was right. But he only figured that out because he said he was trying to figure out what he was doing. He's like, that doesn't make sense. Why is it not working? Most people would just say, oh, whatever. He's a smart guy and everyone knows him. He'll be fine. That's why he stole billions of dollars, because people kept saying, well, whatever. He knows my family. He's fine. And I think one of the challenges in times like this, markets like this are when the frauds come out. And the reason being is when markets are high and things keep going higher, Ponzi schemes are really easy to keep going because people just keep throwing money at you and they don't need it back. But once you hit a recession, all of a sudden people need to start calling their money in. Hey, I need some of that money back because I got to pay off my loan shark or whatever the heck else they're doing. And they want the money back. And well, sorry, I can't give it to you today because it's, someone else took it. And then enough people do that. And then they have to just say, sorry, you caught me. I'm done. It happened with Bernie Madoff and what was the guy's name? Sanford, I think, down in Puerto Rico.
Sanford, they just settled that one. Yeah, that case. That just came out in the news recently.
Yep. I thought that was settled years ago.
Actually, Stanford. Stanford,
yeah. I thought that was settled years ago, back when 2009 or 10, but apparently it just happened. So, and now you've got all these other cryptocurrencies, which I'm not calling them Ponzi schemes or frauds because I'm not sure that they are, although people are alluding to the FTXs. I don't know if it is or not because I'm not an attorney and I don't know all the case data. And anyone who's assuming that they know all the details of what's going on with FTX, unless you're in the inside, you don't. There's the public PR that goes on around that is ridiculous. I mean, they're already calling him a Ponzi scheme before they even had the data. And that should tell you anything about the news. When people come out with information immediately, you have to ask yourself, why do they have that information? They couldn't possibly have that information, so why are they making these claims? And this is not a claim whether what he did is right or wrong or whether he's a fraud or not. I don't know, right? The point is the framework of thinking about things. There's always a fog of war immediately when something happens. People just, what the news does is they'll jump to a conclusion because let's say some building blew up or whatever. Within the first hour, the media is going to speculate that it's terrorists or it's the Russians or it's Chinese or whatever it is. They're going to come out with some answer. Well, the reason is probably not true, right? Here's a good example. Look at, I hate to do this because I'm going to piss a lot of people off, but hey, we do that every week. So, the COVID, right? Where did that come from? Well, I have a client who happens to work in that field, and immediately they said it came from the lab. They said it has all the markers that come from the lab. I am 99.999% sure. Actually, she said, only because I don't want to say 100 because mathematically that's not what we do. But she's like, if I could say it, I would. It's 100%. And then we went on for years saying, oh, it couldn't have been that. It came from a pangolin or whatever the thing was. And now people are saying, yeah, actually it came from the lab. The point is what we hear is rarely the truth. Eventually the truth will come out because enough people come out and say, hey, this is this and this is that. And eventually the truth comes out. But my point is initially we don't have the information. And back then we could, you could argue, well, I knew because I knew this. Well, I didn't know either. I just had one person's word that this is what happened and somebody else's word. So I don't know the truth. I had my own theories, but that's my personal opinion, and everyone else has their personal opinion. Initially, those opinions are probably going to be wrong, and you have to. The only way you can come up with a reason is the media will give it to you, which is mostly what happens, right? The speculation is based on the media. They say, oh, it was this, right? So back in 2011, gold crashed on April 15th, and the media said, oh, it was because people were taking money out to pay their taxes. No, they weren't. They didn't sell gold all on the same day to pay their taxes. That's stupid. Other media said, oh, it's because, the Chinese were trying to plummet the gold market. No, I didn't see that data either, right? And I heard like 10 different definitions, and all 10 were idiotic. You could know nothing about the gold market and know that at least 9 of them were stupid. One of them you had to know a little bit to know that it was stupid. But one thing I knew is nobody could actually know the answer to why it crashed. There was no single person, unless you're in the bowels of the, of the machine, or unless you were the guy or gal who did that, you're not going to know why it happened. And so to me, I laugh every time I see these stories because there's no way you could know some of the truths behind this, but people have to come up with a reason. We as human beings, we don't like a void. We don't like a non-answer. If there's a weather balloon up there and we had to shoot it down, oh, well, it's the Chinese or it's aliens, or you have to come up with a reason. How about we don't know, but they can't say that. Nobody can say we don't know because it makes them look stupid, which I don't think it makes them look stupid, but I think people feel like they need an answer, so they grab onto something. And so I bring all this up because, as we're kind of going through this economic cycles, a lot of people are saying different things. One of them that they've been saying for a while, and I'm going to share this because it is absolutely brilliant, is there's a clipping, and I wish I could give the person credit because I don't know who did this, but it is absolutely brilliant. And it is a clipping of newspapers from different eras. And the top says, it always looks like a soft landing, the news. And it shows 1973, 78, 89, 80, and 2000, 2007, and there's one more. I don't know what year it was, but the point is what it shows is every single year it says economists see a soft landing. Economy should take medicine from 1980. It just says soft landing on the headlines. And I think this is brilliant because everyone is saying, oh, there'll be a soft landing. It's easy. How many times has that ever happened? 0. It's never happened. Not saying it can't, right? I don't know. I mean, maybe the Fed's a magician this time, but history is a guide. They have 100% chance of not having a soft landing if you look at history. It doesn't mean that that'll happen, but I think the point is if you look at this, it shows you that what you read is not accurate. What you read is somebody's opinion in that moment. And then everyone reads it, and then they have that, and then everyone has that as a truth. That's their truth, is that we're going to have a soft landing. Remember the transient, inflation's transient. Remember that? Well, that happened. Now everyone's making fun of the comment transient. At the time, everyone thought, oh, it'll be transient, it'll go away. And then it wasn't transient. Well, apparently, I don't know, it depends on your definition of transient. I don't think it's going away for a while. I think our last PCE and CPI reports show that. But the point is the soft landing is probably going to be a fallacy, but still, people believed it because it was out there in the media, and every paper was saying that. So I just wanted to kind of like start the conversation there, because I think it's really important to understand mental frameworks when it comes to investing. And 3 weeks ago, people were focused on how inflation, we're going to have a pivot in June. It's going to flatline and then start dropping. We're going to go back to sunshines and rainbows and champagne, and everybody's making money. And then the CPI came out, and well, maybe it's going to take longer for inflation to go down. Meanwhile, Powell's over there beating the drum saying, I am not going to drop inflation. I'm not going to drop interest rates. I'm going to keep raising them. And even when I raise them, I'm going to flatline. I'm not going to drop them for a while. He's been saying this. Like there's no questioning what he's thinking. It's been obvious for a long time. And yet, what happens? People don't believe him. Now, I can't blame them, because the Fed's been talking trash for the last 20 years and no one's believing him. The boy who cried wolf, and people stopped believing the Fed a long time ago. However, what he's saying is accurate. It lines up. I think if they did anything but what he's saying, they'd be a band of lunatics, because if you did anything else, you'd create this untenable environment. But what he's been saying, so people are actually starting to come around and believe him. So I think what's important to recognize is people have been saying one thing for over a year, and now they're starting to realize, it's different. Now you're going to start to see a new talk track. Oh, well, we're going to have interest rates higher than a lot longer. What's happened? Interest rates are going up. 5% U.S. Treasuries and higher. You have 7% mortgage rates. The long end of the curve is going to start increasing, because hey, maybe they'll have 5%, 6% interest rates for a while, which means the long end of the curve, which means it's like the 5, 10, 20, 30 years. That's the long end. The short end is like 3 months, 6 months, 9 months. So in the longer end of the yield curve, it just means that stuff is going to start to creep up, which means that a lot more bonds are going to lose value. $22 trillion of stock market wealth was wiped out in 2022. $22 trillion. Now, I don't know the size of that market completely, but 22 trillion is a hell of a lot of money to be wiped out in 1 year. And that was the market going down 20%, 20 to 30, depending on which index you're looking at. Now, imagine the S&P was down 19.4% last year. The NASDAQ was down 33. So let's call it 25. Let's split the difference. The Dow was only down 9 or 8.9. So let's just call it 20. Let's just be conservative. The stock market's down 20%, $22 trillion. What if it goes down another 20 or 40% this year or next year? That's an enormous amount of wealth that's wiped out. And I guess the question is, when you start to see the puzzle pieces start to line up, like Doug and I have been saying for the last year, at what point do you wake up and do you say, oh crap, I got it wrong? And I don't mean that we're geniuses. We're not. We're just, maybe better than average guys. I can't speak for Doug, but maybe I'm a little bit, I like to believe I'm better than average. I think 80% of the public thinks they're smarter than average, which I think is a funny statistic. But, look, even if we're average, we're average intelligence. People out there are not believing this. At some point, they have to start believing it. And when they do, there's going to be a rush for the door. And I do not want to be in that movie theater when somebody else fires. So I don't know your thoughts, Doug. I spoke a little bit too long there.
I'm going to spend time catching up on you, Kirk. No, it goes back to what you said at the beginning. It made me think of something when you said stop. When you see something and it seems too good to be true or seems just unusual, stop what you're doing. It made me think of the lines from the Eurythmics hit Missionary Man. Stop what you're doing. Get down upon your knees. I have a message for you that you got to believe. Okay. We have been driving this message home week after week after week that things look different. They smell different. And let's face it, they will be different. I also want to clarify something, Kirk. I am fascinatingly average. So, but going back to those articles, I do wanted to say, what I thought was really interesting, and I'm not really looking at the 1980 or 1973. I haven't looked at the data, but I find something interesting in the 2000 soft landing expected 2000 and the soft landing expected 2007. And I believe that that's also correct in 1989. And I think we're going to see that pattern repeat itself on the number of those. Do you notice when the real crash came? Was it 2007? No.
For which asset? 2008 was the crash, but real estate stopped earlier.
Real estate stopped early, but that didn't really cause a lot of pain across the global perspective. It all really caught up a year later when everything unloaded. It was the crack in the ice that all of a sudden people heard that crack and somebody might have fallen through that hole right where the ice broke. But the rest of the people on the lake were still walking along without any thought or impact to what had occurred at that simple ice hole. But unfortunately, they became the ice hole. Because all of a sudden the crack continued, and by 2008, it took down the entire lake and everybody on it. If we go back to the .com implosion, 2000, guess what? It was rough. But where did we really see the major downturns and the collapse? It started 2001, 2002, okay? So again, I would go back to the patterns that we're looking at in a lot of those images in those articles is that I think, unfortunately what happens is a lot of times these articles are premature. They look at volatility. And we've talked about this before, the difference between volatility and risk. They look at the volatility and say, you know what? The volatility is going to subdue itself. Everything's going to be okay. And the market's going to continue. But they're ignoring the risk. And the risk didn't go away in any of those circumstances. I believe 1990 was worse than 1989. That's why I'm saying, I think if I go back on these articles, a lot of these articles are repeatedly premature. They ignore risk and only talk about volatility. And volatility can give you a soft landing on a temporary basis. But if we do not subdue the risks that are out there, then we have to be prepared for when those risks actually break all of the ice. So I think the real takeaway here is look at those cracks and then go back and look at the cracks and say, hey, did the temperatures drop again? Did it refreeze? Are we good? If all of a sudden we're still sitting in like 33, 35 degree weather, guess what's going to happen? Probably a high probability that the rest of the ice is going to weaken at some point and collapse underneath it. We haven't removed the problem. And I think that's the issue that goes on so many times in these conversations and these articles. And again, right now, what are we seeing again? Soft landing. I mean, the only difference this time is unlike, what was going on in 2008, for example. All right. 2008, a lot of the problems were hidden. Right. It was there. You kind of looked at some things and think this seems a little bit strange. Liar loans driving up this real estate. You can look at the economy and say, gosh, I just don't see why they're building homes everywhere and everywhere and everywhere. Something's got to give. But let's face it, most of the mortgage-backed security crisis, this became a credit problem. Those were packaged and hidden so well that even the smart institutional investors that were buying those MBSs didn't realize how much bad high-risk credit was being packaged in what they thought were supposed to be highly secure, low-risk mortgage-backed securities. Once they found out and began to distrust those mortgage-backed securities that they were buying, that's when immediately overnight the credit market froze because nobody trusted the credit they were buying and they refused to continue to buy it. Bam, freeze up the credit markets, collapse. That's one nobody could see coming. Okay. Unless you were really looking deep, and there were a handful. We always go back to, they've done movies about this, that there were a few people screaming, look, we got a problem. But even within their own entities and institutions, there's institutions fighting against them. But it was still kind of a small niche world that was watching very, very difficult data to see. Go back to the .coms. I think we had a little bit more of an indication when buy.com doesn't make $1, or companies were started with 15 employees or less and selling for $1 billion within like a week of being open. Yeah, maybe you should probably make some pretty smart decisions that this isn't going to last. But greed was driving, well, hey, I can buy this stock that has nothing and immediately turn around and make money. I'm telling everybody, this time it is different. What's different about it? The Fed is controlling this rhetoric. The Fed single-handedly is making decisions on what's going to occur next. And I actually had a conversation with someone yesterday was asking, well, how come, there was, wasn't more of this or wasn't more of that in last year? And the problem with that is that we really were trying to wait to see what is the Fed going to say. And one of the biggest things, just like the soft landing argument, one of the bigger things that frustrates me is that, and I'm just going to put it out there, the stupidest thing that anybody can say and the stupidest thing that anybody can follow is it's already priced in. Why is that stupid? Because priced in, again, we know this about stock markets. Stock markets are always looking at what is the outlook look like and what do we expect to see? And yeah, so pricing it is what we're looking at for the next quarter or so. Do we expect some volatility? Do we expect a 1/4 point interest rate hike? All right, well, that's been priced in. The problem is it only takes a slight variance of that. Okay, because they're expecting, priced in means if everything goes exactly as they've assumed, it's priced in. Kirk, when does anything go exactly as assumed?
Rarely, Doug.
Rarely.
Rarely.
Rarely everything is 100% spot on to what's expected. Now, and again, with the Fed, we have a little bit more of an education in this because we could say, well, we think they can hint, we're going to come up to a 1/4 point. We're going to do a 1/4 point. As long as it's a 1/4 point, it's good. But when new data comes out, and you have a Fed chair that has literally told you over and over again, I will not change from my mandate. I don't care what you think. I don't care how happy-dory you're getting. I don't care how good feeling you're going to get. I don't care about the articles on soft landings. I am telling you, I will do everything I can to raise interest rates, to squeeze the life out of the economy, to combat inflation. Stop listening to the news. Stop listening to talking heads. I'm the one who controls this button and my finger's on it. As long as he raises 1/4%, we're fine. But we get new data like yesterday, raised at 0.5%, bam, it's no longer priced in. And we have to be very, very cognizant of what's going on and be prepared that certainty of uncertainty, that volatility. This time we're being told a very clear script of what's going on. And if you're not listening, well, that's on you.
I think one of the challenges, and we brought this up a few weeks ago, is, there's this terminology of don't fight the Fed. People talk about it. They say it in the news. It's commonplace. Everyone knows it. Don't fight the Fed. Well, what that means, if you're not familiar, it means if the Fed is lowering interest rates and they're printing money, buy the stock market. That's what it means. It means the risk is really low of a crisis because the Fed is pumping liquidity into the system. So the point, don't fight the Fed, is, hey, the Fed is the big bully in the schoolyard. So you want to side with the big bully, not the weak kid in the playground. And so you want to go with the Fed, and that's always been the sentiment. The problem is when the Fed goes the other way, you never hear people talking about don't fight the Fed. That just disappears, and then it comes back when the Fed starts printing money. Oh, don't fight the Fed. Where were you when the Fed was not printing money and they were raising interest rates? The answer is still the same. Don't fight the Fed. So what that means is, it means if the Fed is not printing money and they're not raising and they are raising interest rates, it means that there's a high likelihood at some point the market's going to decline. And yeah, we saw 20%. And for those of you who thought 20% was a crash, you got to wake up. That was not a crash. We are still I don't know what it is today. Every day is different, but we're like 10%, 5 to 10% above all-time highs prior to COVID. Now, do you think the economy got better after COVID? No, it didn't. If anything, at best case scenario, it was the same, right? And some things were better, some were worse, but let's just call it the same. So you're above where it was prior to COVID. That's when the whole economy was running smoothly, everything was efficient, big profit margins. And now you've got high inflation, profit margins are getting squeezed, whole industries are shutting down, but yet we're higher in the stock market than we were prior to COVID. That's just insanity. So when people say don't fight the Fed, we put this out, a few weeks ago. Don't fight the Fed. I'm going to say the same thing. Don't fight the Fed now. You're being silly if you think it's going to go up. Now, if the Fed comes out and decides, hey, we're going to start lowering interest rates and printing money, I'm going to say the same thing. Don't fight the Fed. That means, go long and take risks. But right now, if you're taking risks, you're in trouble. Now, one thing I want to show you here is we brought up some charts. And this one is basically debt. And if you look at debt, it has bank debt, it has insurance, CMBS, GSE, which is agency bonds, debt fund, and other. And it doesn't really matter which each one of these are. It's more to the matter of here is the amount. So these are maturities, and these are when the debt is maturing. So right now, the debt is maturing in 2023. Over $1 trillion is maturing, right? And this data is probably a little old, so don't. I know I'm going to get hate mail for this, but I just want to conceptually show you that over the next 2 years, a lot of debt is going to mature. And wait a minute, are rates higher, Doug? So we were at 0% interest rates, and now they're at 5 to 7, and they have to basically issue new debt at 5 to 7 as opposed to 0. What do you think that's going to do to interest rates? Well, you don't have to imagine. I'm going to show you. Here's the next chart. Federal government debt, current expenditures from 1950 till looks like somewhere around today. Well, I don't know if you notice on this chart, and if you're just listening at home, please go to the website, go to LinkedIn, you'll be able to see the chart. And the chart shows that it started to increase certainly around the late 70s until 2000, and then it kind of flatlined a little bit. And then right around COVID or the last few years, it just spiked. In the last year or so, it spiked from 600 billion to about 850 billion. Nothing like that prior to history. Now, you've got a lot more debt. What else is going to happen? Oh, wait, a lot of that's going to roll over. And now it's going to be a lot higher. So where does that with interest payments? So these are interest payments. Interest payments are going through the roof, right? So how high do you think that's going to go as this stuff starts to mature and have to be rolled over again? It's going to skyrocket. And we're not even at 10%. We're at 5%, which is more historically normal than anything else. And I wish I had this chart in front of me, but there's I think it's called an asymptotic curve, where you basically have an X and a Y, and you basically have a curve that's hugging both axes. And the point is when you have 0% interest rates, how much can you borrow? Well, you can borrow an infinity, right? Because you're not paying any money for it, so you can borrow as much as they'll lend you. Now, if you have interest rates at 100, how much are you going to borrow? Well, you're not going to borrow anything because you can't afford 100% interest rates. So debt is low at 100%, and debt is infinity when it gets to 0, or negative in the case of Europe, right? Is more than infinity. But if you look at that, like somewhere on the curve, as you get higher in interest rates, the amount of debt you can support drops because you can't support the same amount of interest payments. That is what's happening. It is not going to happen to us all up front. So I know people send out these charts and they're like, oh my God, the world's going to end. The budget's going to blow out. Yeah, over time, just like real estate's not going to crash tomorrow. We think it'll probably go down 20% this year, but it's not going to crash tomorrow. It's going to crash over the next 5 years. And that's not a crash. You get my point. So the point is these things operate at very, very slow speeds. So I'm not worried about the federal government defaulting on debt tomorrow. In the next 10 years, I might be, but not tomorrow because there's still debt outstanding and it's still 0%. So until all that rolls over, then I'll start to worry. Mid to early 2030s, I'm worried. Social Security, Medicare, and pensions are all bankrupt right around the same time. I'm worried about that. I'm worried about the U.S. government defaulting in the next 5 years. No, I'm not. I'm not worried. I think there's certainly a risk of it, but I think the risk is low since we can print our own money. So I wanted to point that out. But I did want, since we're talking about debt, let's talk about car loans, Doug, because you presented some great charts here, and I'm going to try to pull some up here.
This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today.
Yeah, well, let's start with one thing different than that first, because I thought it's kind of a good segue, because you talked about rising interest and how much you can afford on debt, and the car payments go into that. But let's start with the real estate market, because you just talked about what's going to happen there. We actually pulled some new information. I know we talked a lot about this last week, that according to a lot of data out there, we're starting to see some real pressures on real estate in many markets around the United States, places, generally speaking, where real estate prices shot up. There was a post of a house in Austin that had been listed for $400,000 in July of 2022. It has now dropped to $230,000 listing. And I believe that, according to what I just saw, kind of pulling it up there in the price history, it has now actually gone into contract. So congratulations to whoever owns that. They are now going to get a buyer to give them a whopping $230,000. So this pending sale finally occurred after they actually, the pending sale is going to be $275,000. So it looks like they might get a little bit of a bump, but over a 1 year, less than a 1 year time frame, we're talking about 7 months. This went from $400,000, which at the time was probably a reasonable valuation in the Austin market. They dropped it within about 10 days to $385,000, and then they dropped it to $350,000, and then $300,000, all by September of last year. And this thing had been sitting at $275,000 offer, which again, we're talking $125,000 price reduction that they did within a month and a half. It had been sitting there since September of last year. Here we go into spring. Looks like a pending sale is occurring. A pending sale did finally occur. It looks like, actually, I'm looking at the data, the history here, September of last year. So it may have sold by now, although actually looking at the pending sale, I'm not sure it did sell. I think they've now dropped it to $230,000, and I don't know if the pending sale ever went through, Kirk.
So, well, Doug, I got a question for you before you go on. That $275,000, you know what drop that is? 31%. You know what 230,000 is? 43% drop. Isn't that in line with what we've been saying, around 40%?
I believe that's the case. I mean, I'm talking to people in Dallas and Denver and places like that, and they're convinced that is not occurring. Guess what? Here's a prime example of the desperation that people are running into to sell when they need to, and the lack of liquidity. As I said, the investors are gone. Nobody's applying for mortgages. And if there's no money from cash and there's no money from mortgages, I think that means there's no money. And if there's no money,
you're right.
I think you need that to be a buyer. I mean, it's one thing to say, I'll give you a $230,000 IOU and we'll get back to you. I think one thing about real estate, and I talk about this all the time, between using your own money and using other people's money. And same thing for college. You can take a student loan, okay, or you could pay cash. But the seller, whether it's college selling tuition services or it's the house selling the house, they're not financing. Now, there is such thing as seller financing. I'm not going to get into that right now. They want their money today. So whoever's selling that is going to get that $230,000 right now. So guess what? If there's no mortgages and there's no cash, that seller's not taking an IOU for 230. They want that money right now. And the stats are telling you nobody's coming to the table with any. That's scary. But let's also talk then, like you said, about autos, because, mortgages and cars have something similar. It's an asset. The seller wants their money right now, and they're going to expect to be paid off of that. And that's usually going to take some sort of a lending. And so Americans are now paying a record $717 per month for new cars. So as a share of new car monthly payments over $1,000, it has jumped to roughly consistently somewhere in the range of 2.5% of all cars that were sold from like 2010 all the way through 2016, 2018. Roughly consistently about, let's say 3 to 5, less than 5% of all cars that were sold were selling with a payment of $1,000. Since 2020, it went from very rapidly from less than 5% to now and this data looks like it comes through Q4 of 2022. 15% of all new cars being sold right now are over $1,000. That brings an average, of course, driving that up to that $717 a month. Yeah. So now the share of 1,000 and up payments is approaching 16%. That is what, roughly 1 in 8 or 1 in 7 cars, if I'm doing my math really quickly, has a payment over $1,000. Now, I did look. One of the nice things about the reventure, we talked about them before with real estate. One of the nice things that they have is they actually have a chart data that you can look at that shows what the average income, the median income is per city. There's been a tremendous spike in the median income that people have been able to take home over the last 5 to 10 years. On average, I was looking at it quickly, 20 grand increases in income. But as we all know, the income increase is not kept up with the increases in housing, college, etc. So even though people are making more money, the average person cannot truly and gainfully swallow $1,000 a month just to go out to their car. And I don't know if they're looking at 48-month loans, but a lot of people are starting to get more longer term loans like 60 months, 72 month, 84-month loans. So you're looking at $12,000 a year in payments, potentially for the next 7 years. And this is something I talk to people about at college planning. It's actually an idea, a point that was given to me by someone else. I'll give credit to a gentleman by the name of Ron Carruthers, talks about this and says, look, when you are going into financial planning and looking at things, most people look at them as a silo. You need that car. You're just looking at what can I afford right now? And if you think, and I need that car, I'm going to go ahead, get this loan for $1,000 a month because I'm fine right this second. A lot of things can change. But also sometimes what you think you can afford at that moment is not what you really can afford to continue to do long term. Think of it like a diet. It's February, it's March, Kirk. Guess what just ended for many, many people? New Year's resolutions. They came into New Year's thinking, I'm going to lose 30 pounds this year. How am I going to lose 30 pounds? This is the year I stop drinking wine. This is the year I stop eating junk food. Matter of fact, this is the year I'm going to eat salads every day because I'm going to be the new me. Well, guess what happens? We get to March and most of the people that said they're just going to eat leafy greens all day, maybe get a little bit of a bump of some salad dressing. It's going to taste good. And now by this point, they're literally ordering Domino's 4 days a week. Right? They are done. They are so burnt out on what they glorified as an ideal amount of spending that at the time sounded great. but unfortunately the suffering, and we've seen this data in other areas. We're starting to see a spike on people that are running 30 days delinquent on housing payments. We're starting to see a spike on people that are running delinquent on auto payments. It only takes a little bit more disruption, and all of a sudden 60 and 90-day delinquency spike. And that's when you start getting into repossessions. That's when you start getting into foreclosures. That has a rippling effect on the whole market. We are in this is perfect stagflation right here, because we are still in a situation where the car inventory is still anemic. It's not available. So we're seeing a massive inflation in the prices, but we're also seeing simultaneously a drop in demand. Okay. So because the supply is still very limited, and the demand is going to start to wane, because $1,000 a month is not something that people can continue that diet. And eventually we're just not going to get to the point where they're even going to try to eat the salad, because now the salad's too expensive. So I think this is a huge and a very telling issue about how cash flow in America is starting to erode incredibly rapidly in inflationary areas. And again, this car payment, this $1,000 car payment, it's just one thing, right? That's $1,000. So let's say the average person brings home, if you make $175,000 a year, you're going to pay about $25,000 in tax. Okay. Then you got a housing payment. We know that's expensive. Now you got, maybe $2,000 between escrow and housing that, to be able to cover where you're going to live. You still got to eat. And then you got college coming in there that might eat $2,000 to $3,000 a month. And now you got another $1,000 a month car payment. This is before you've considered saving for your retirement. This is before you've considered any kind of vacations you want to take with your family or anything else for lifestyle. All of a sudden, very rapidly, there's nothing left. And unfortunately, even worse, there's a negative cash flow. And again, because most people don't save very well, where do they have to turn now? To credit cards and debt. And that goes back to our first point today. If they turn to credit cards and debt, and we see a continuing spike on interest rates on those payments, I'll let you do your own imagination there and speculation of where that's going to lead us.
Yeah, I think that you're hitting the nail on the head, Doug, is, we're going to start to see quite a bit of changes in the market that people are not expecting. And the bullwhip effect that we've had prior to this that we talked about is only going to get exacerbated. And I don't think people really fully understand the gravity of what's going on, in part because this has been a very manageable decline. It's not a crash, it's not a liquidation, the world's not ending. It is just like the 70s, where it feels painful. Like it's like this dull pain that never goes away, that just continues every single day. And that's what people are going to have. And I think it's going to be challenging. But, the brighter side of this, Doug, is that there is going to be a ton of opportunity, right? We're here not to depress you and tell you the world's going to end, but to talk about the opportunity. So, you think about the car market, right? My wife's going to be in the market for a car soon. I mean, we're not car people. Like, I'm going to drive my car until I look like the Flintstones and the wheels aren't there and I'm running down the street with the car in my back. Like, I don't get new cars. I could care less. They're not an investment. For me, it's a depreciating asset, and I really could give two craps about a car as long as it gets me from point A to point B without too many troubles. So, I got a Honda Pilot. This thing will probably last me another 150,000 miles and it'll be good. But, I'm looking at the market thinking, I like my car. It's solid, knock on wood. It's given me, very little to any problems. And, but if things get cheap enough, I'm not going to be afraid to go out there and get a new car, right? If they're giving them away and they can't give them away, sure, I'll go out and get a new car, right? If it's cheap, but they haven't been cheap lately. And people are willing to overpay because, well, my car, it's a year old and, I got a little scuff under the seat that nobody can see. I need a new car. And that's the way some people are, and that's fine. But you need to think about where your money is going to be spent in the next 10 years, because if you're cutting your budget close, then you need to really be meticulous about where you're spending. like I said, world's not going to end, but I can't tell you how many stories I've had in the last few months from clients who are worried about their job. And it's not because they're bad employees. These are people who say everyone loves them, they're irreplaceable, but they recognize if things get bad and they have to cut, where are they going to cut? Well, they're not going to cut the low priced 25-year-old. They're going to cut the high priced 65-year-old because why not? Right? I'm going to save a few bucks. And who cares if the numbers get screwed up once in a while? You're going to start to see that a lot more. And so the demographic shifts that are going to happen are going to be, I think, surprising a lot of people. I do want to show this because this was interesting to me. We saw this, and it's the cost for a family to retire comfortably in every single country. Now, everything's a little different. If we look at this, we've got the U.S., which is $700,000 on average. Mexico's $300,000, which makes you maybe want to move to Mexico, assuming that the crime is in place. But you look at South America, like Colombia's $200,000. Well, people think like, well, Colombia, that's dangerous. No, actually, Colombia is a great place now. They've really cleaned up their act since since a few decades ago, and it was a little bit of a challenge there, crime-wise. But you have a lot of Central America, South America that are actually reasonably priced. If you had 200,000, you could retire comfortably in some of these countries. South America, Argentina, 250,000. Uruguay is 450. You could go to like Europe, 350,000. Well, that's maybe Eastern Europe, but Western Europe's probably a little more expensive, 400, 500. So the point is if you're really looking for a place to retire, this is actually a great tool. And then I want to show you the U.S. So that was the countries, which the U.S. I think was 700. This is the U.S., which for the most part, East Coast is between 600 and 700. Some places in the FlyO states that are like 500 to 600. Then, of course, you got the West Coast, and then you got Hawaii, which is about 900. So the point is if you're looking to retire comfortably, these are good ballparks. Now, should this be your target number, Doug? Because they put a number on a page and said it's 600. Should this be your target number?
You know what I think about generalizations? Absolutely not.
Yeah. So this is a good ballpark number. If you know nothing, you put no time into your own finances, into your own financial planning, and your own thinking around retirement, it's a good starting point. But that would be about all it is. It's a good starting point because in each of these states, you could retire comfortably. If Wyoming is 600,000, you could retire comfortably on 300,000 or 2 million. It depends on what your expenses are. It depends on what you need, quote unquote, need to feel comfortable in retirement. Now, I'm a little bit more old school. I don't even need a bed. Just give me a place to lie my head and I'm good. Like I don't, give me one of those tiny houses. I just need a place to sleep, and a place to read, and I'm good. And just go walking every day. So I don't have an expensive taste like that. Some people do. It's not judgment, but you need to know what they are and you need to accommodate yourself. So I think in thinking about that, you should look around, not just in our country, look in other countries. A lot of people retire in Central America, South America, where the costs are a lot cheaper and the quality of life is really high. Some people claim the quality of life is even higher than it is in the U.S., in large part because of some of the shenanigans going on in the U.S. But look, you get good medical care in a lot of these countries for $200,000 to $300,000 in South America. You could retire comfortably, and I know a lot of people who do that. And some of these people are multimillionaires and they retire there because they love the people. But the point is I just wanted to bring it up just to put things in perspective. Those numbers aren't going to go down, Doug. Why? Because we have inflation and costs are going to go up, which means the cost for retiring are going up. And that's at the same time that your wealth is going down because you're invested in the stock market in a 60-40 portfolio or whatever portfolio you're in that is not managing risk. So if you're not managing risk over the next few years, don't say I didn't warn you. If you're close to retirement or close within 10 years, close, because I think this economic malaise we're going through is going to last a while. If you're unless you're 30, you should be thinking about how can I preserve my wealth and then take advantage of opportunities when they come up. The market down 20% is not an opportunity. The market down 60% is an opportunity. Even 40, I could argue, is getting in the ballpark. So just make sure that you keep in mind you have a risk management strategy. You have a strategy to make money in times of distress. If you just bought a new car, well, maybe you're not going to need a new car when they flood the market in a year or whenever it is, or houses. But just be mindful of, every week we talk about this in the show. We talk about strategies. We talk about our thoughts. We're telling you how to think about investing. I'm not saying, hey, you need to go buy a new car because they're flooding the market. I mean, granted, I might say that if it's obvious, but you should start thinking about it, right? We talked about bonds 3 months ago. We said you should start thinking about bonds. I can't tell you how much hate mail. Doug, how much hate mail do we get from that comment? People, I thought everybody hated us after that one.
Oh, it was endless because, of course, people were following rhetoric and they were listening to the impact of bonds and how bad they were. But again, as the bond values changed, so does the recommendation.
Right. And the point is we said that because we knew at some point in time in the near future, things are going to change. People were against bonds. We were against bonds 10 years ago. We hadn't owned bonds in like 10 years because interest rates were zero. So it didn't make any sense. And now that rates are going up, people are freaking out. Oh my God, I got to get rid of my bonds. Well, it's too late. Well, now it's a time to actually consider looking at bonds. I'm not saying put all your money in bonds, but if you do it right, you can get 5% right now. Do I trust the stock market to get 5%? Nope. I don't. I mean, some people might. I don't. So at some point, this balance of risk and reward changes. When interest rates are zero, well, the chances of making money in bonds is zero or close to zero. And then, so where are you going to get your income? Where are you going to get your returns? Well, stocks. So everybody pumped money into stocks. So the amount of money in stocks is way up here and the amount in bonds is way down here. Well, at some point, bonds start to creep up and they're 5%. Well, crap, 5%. I'm going to take some money out of my stocks and put it into bonds, and all of a sudden stocks creep down. Well, where's that money coming from? It's from people selling their stocks, which depresses stock prices, which means more people sell them and put into bonds. So there's a balance of the amount of money out there. It has to go somewhere. But at some point in time, bonds become attractive. And the reason we said it 3 months ago is because we realized right around now, they would start to be attractive. And we have money in bonds now, like short term, but we have it because you can get really attractive rates. And at some point, that's going to change and it will no longer be attractive. But right now, it's pretty attractive compared to the alternatives, which are, commodities, real estate, stocks, you name it, go across the board. They're higher if you look at everything and rank them, right, in terms of what's most attractive, not if it's good, right? It's just if it's most attractive relative to everything else. Bonds, I would say, are really high up here compared to everything else. Even though they might be unattractive long term, right now compared to everything else, if you have to put your money somewhere and not in cash, that's a pretty attractive place. So it's how to think about things. Most times people have to think about things relative to other things. And I say this because most people don't understand how gold works. Gold in itself is not valuable. Gold is in compared to the dollar because we live in the U.S. For those of you who don't live in the U.S., I know we have a lot of international listeners. It's compared to your own currency. So there's always one thing compared to another. If you're looking at the Japanese yen or the euro, that's compared to the dollar. So one is compared to the other. So you're always comparing your cash versus something else, and which is more attractive. Well, for us, bonds are really attractive right now. And like I said, that might change anytime, but just something to think about as we kind of wrap it up here. Doug, why don't you kind of take us home here as we're wrapping it up?
Well, I want to go back to what you talked about, cost of living and generalizations. I was actually talking to someone yesterday. Again, sometimes there's, people are thinking about planning or kind of what they should prepare for. A lot of times what their generalizations be like, well, you should use 80% of your current income, or you should use X percent of your current expenses. Listen, I don't work in generalizations. I work in math and science. I had a client of mine who's a dentist. This lady makes about $350,000 to $400,000 a year. And she said, well, I was just talking to my CPA about what I should need for retirement. Now she makes $350,000 to $400,000 a year from her business. She ends up saving about the maximum, so somewhere around $60,000 a year into her 401k. And she's also accumulated a very good stockpile of cash over the last couple of years that has put her at around $600,000 in cash. Okay. So based on that information, Kirk, does it sound like she's spending $350,000? No,
I don't know.
She can't be, because she's been saving, over at least $100,000 or more a year into cash and her 401k. So clearly the amount she's actually spending to live off of, without getting into the granular detail, is got to be income minus what I've saved, right? Because I can't spend what I've saved. The generic advice that she was given by her CPA is, well, you should be looking at two times your income when you retire. So she did the math. She's like, so I need to prepare to spend $700,000 a year the first year I retire? Absolutely not. What a terrible generalization. You're not spending $350 now. You're saving $150,000 a year of that. So to use income or generalizations and such like that without looking at the actual details is incredibly short-sighted. Okay. What it really comes down to is and it goes back to the state, where you're going to live and where it's going to be less expensive to live and how much you're going to need. You have to do a thorough financial plan based on your own cash flow needs. What is it going to cost you to live the standard of living that you want, and then go from there? And that usually takes either a really good knowledge of this, or it's going to take getting the help of someone who actually does planning based on math and science of your own situation. So going back to the state information there on state to state, don't use those numbers and think that's what it's going to be for you. Like Kirk said, it might be more or less. You have to really take the time. And unfortunately, people don't have time, and they don't take the time to thoroughly vet their own financial situation, to really look at what they think they're going to make. They look at some calculator on Fidelity. It says, Fidelity says I'm going to need this, because they lump you into a category with everybody else. I've never met two people who live exactly the same lifestyle. I also wanted to kind of point on the United States map that it's really showing that there's only one state in the entire country that they're estimating is going to be less than $500,000 in cost, and that's Mississippi. Every single other state in the United States is at $500,000 or above to live. And as you mentioned, the coasts are definitely going to be the most expensive places to live. And if you're looking internationally, I actually knew a gentleman who's worth, a couple $1 million that moved to Honduras when he retired at a pretty good age. He loves it down there. He's scuba diving all the time and living in the sun and the exotic animals and the wildlife. He has been fabulously happy. Looking at the 10 cheapest countries to retire, India, $186,000 a year. I love Indian food. Not sure India as a whole is the right place for me, but again, this may be something that some people are going to have to consider more of, based on what has been widely published, the savings rates of Americans, which unfortunately is well below what it needs to be for what most people are going to need. So again, there's other ways to look at how to retire that sometimes, again, thinks outside the box. And as I tell people when I talk to them, when you have something outside of the box, you can do one of two things. You can reject it, or you can get a bigger box. And I think that there's going to be more thinking around creativity on how to make it work, because ultimately, if you're in your 50s now and you haven't saved anything, you're not going to very likely be able to save enough in the next 15 years to be able to live maybe where you are. If you live on the coast, and some people say, well, just buy a cheaper house. Okay, good luck with that. You're going to have to move. It doesn't exist in Southern California. All right. So again, lots of generic advice out there. Unfortunately, it's a starting point, but if you don't do the work and get real advice and math and science about your own situation, then you basically don't have a plan. And what's the old saying? Failure to plan is what, Kirk?
Planning to fail.
Planning to fail. The last thing, I want to leave a little bit of hope. Kirk did talk about, and it makes sense, anytime the interest rates go up, markets tend to go down initially. And we're not going to get into it probably with the sake of time that we have this time, but we can talk a little bit more about the long-term correlation between the stock market and rising interest rates. And it's actually not what most people think. That technically there has actually been some decent correlation between rising interest rate environments and rising stock market environments. Like you said, Kirk, before, with these problems comes opportunity. The stock market can be one of those opportunities. But in the short term, when they're adjusting interest rates, there's going to be a shock factor. And we're all starting to feel that now. So it's going to take some time to get through the shock before those opportunities rear their heads. And that means there's going to be one thing you're going to need to do through this entire process: patience. Patience, prudence, wait for your opportunities. And again, this comes back to one of the best asset classes that you can have all the time: cash. Cash will give you that flexibility. There's never a time in which having some cash is a bad thing. All right, we talked about inflation. We talked about opportunity. I'm going to talk to you a couple about one of the areas of inflation is college planning. I mentioned college costs before and the impact that most people have. Most people go into college thinking, no problem, I can go ahead and I can pay for college. I've got the money. And I ask them, I say, well, if you got the money, how come you're not saving that money now? There's a belief that you can just get into college and adjust your lifestyle to correlate to a couple $1,000s a month. And then you get a second kid coming along and you're going to correlate to losing $4,000 a month in your budget. This goes back to the diet analogy. Don't just think you can live off lettuce. Have a plan for college going into it. We have a 9-step process through our company, ProCollege Planners, that helps people to really understand and get the right budget for college, to pick the right colleges, get the scholarships, get your child positioned to get into a great school and get all the money that you deserve from discounts and aid and scholarships. Check us out at procollegeplanners.com. And actually, if you're going to do one thing right now, go there and download our free checklist. We update this annually based on real numbers. The 2022 and 2023 data is out there right now. Go to procollegeplanners.com, download it for free, and get it today.
Thanks, Doug. Appreciate you coming on the show, and hopefully next time you don't disparage lettuce. I'm not happy about that.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.